Cryptocurrency has captured the imagination of millions, promising astronomical returns and financial freedom. But for ultra wealthy, the calculus is different. They didn't amass their fortunes by chasing get rich quick schemes or following the latest investment fads.
Bitcoin is worthless artificial gold.
Bitcoin itself is a hyped up fraud.
Blockchain, that is a good thing. Bitcoin and ICOs, I agree completely. It's one of the crazier speculative things.
Take Warren Buffett, a legendary investor who famously avoided investing in cryptocurrency, calling it rat poison squared.
Probably rat poison squared.
He has also said that cryptocurrency has no intrinsic value. It's purely speculative, and I don't invest in things I don't understand. Buffett's skepticism highlights a fundamental difference in investment philosophy. While cryptocurrency enthusiasts see digital assets as the future of finance, traditional investors like Buffett prioritize tangible assets with proven track records. Consider real estate, for instance. Unlike cryptocurrency, real estate offers tangible value in the form of land, buildings, and rental income. It's a time-tested investment vehicle that provides stability, cash flow, and tax benefits. Warren Buffett once said, "If everyone in this room collectively owned all the farmland in the United States and offered me a 1% stake in it for $25 billion, I'd swiftly write a check this afternoon, effectively owning 1% of the farmland." Similarly, if you informed me that you possessed all the apartment buildings in the United States and proposed a 1% stake for $25 billion, I would eagerly write you a check. However, if you were to claim ownership of all the Bitcoin in the world and offered it to me for $25, I would decline. The reason behind, what utility would I derive from it? I would be compelled to sell it back to you or seek alternative means of utilization. In comparison, apartments generate steady income and farmlands produce essential food supplies, ensuring their value and utility over time. Similarly, a diversified stock portfolio composed of established companies with strong fundamentals offers long-term growth potential and dividends. Unlike the volatile swings of cryptocurrency, stocks provide stability and predictable returns over time. Then there is gold, the ultimate store of value. For centuries, gold has served as a hedge against inflation and currency devaluation. Its scarcity and universal appeal make it a timeless asset favored by the rich and powerful. So, why don't the rich invest in cryptocurrency? Why the ultra wealthy often prioritize protecting their portfolios over chasing risky investment, particularly when it comes to volatile assets like cryptocurrencies? It boils down to risk, volatility, and a preference for tangible assets with intrinsic value. While cryptocurrency may hold promise for some, the ultra wealthy prefer to stick with what they know best, tried and true investment strategies that have stood the test of time. You see, once individuals reach a certain level of wealth, their primary goal shifts from making significant profits to safeguarding and preserving their hard-earned assets. If you're already wealthy, why would you want to expose yourselves to the roller coaster ride of the most volatile asset classes? It's all about risk management. These individuals have worked tirelessly to achieve financial stability, so it's only natural that they prioritize protecting their wealth over chasing high-risk investments. And if you take a closer look at the strategies employed by private banks, which cater to the ultra-wealthy, you will notice a common trend. Very few, if any, institutions recommend exposure to cryptocurrencies. Financial advisors say that when it comes to strategic and tactical asset allocation for high net worth individuals, their primary focus is on preserving capital and generating consistent returns over the long term. Cryptocurrencies, with their extreme volatility and speculative nature, simply don't align with that objective. So, why should the ultra wealthy invest in the most volatile asset when their primary goal is to protect their wealth? It's a question worth considering. Let's take a closer look at the nature of cryptocurrencies and why they may not be the best fit for high net worth individuals. Cryptocurrencies like Bitcoin and Ethereum have garnered significant attention in recent years for their potential to deliver astronomical returns. However, they also come with inherent risks, including extreme price volatility and regulatory uncertainty. For this, financial analysts say that the cryptocurrency market is highly speculative and prone to wild price swings. While some individuals have made fortunes investing in cryptocurrencies, others have suffered significant losses due to market fluctuations and security breaches. In addition to volatility, cryptocurrencies also face regulatory challenges and security risks. Governments around the world are still grappling with how to regulate digital assets, which adds another layer of uncertainty for investors. Now, let's examine the strategies employed by private banks to protect the wealth of their ultra wealthy clients. Financial planners say that their approach to wealth management for high net worth individuals is centered around diversification, risk management, and long term planning. They focus on building robust portfolios comprised of a mix of traditional assets such as stocks, bonds, real estate, and alternative investments. By diversifying their portfolios across a range of asset classes, investors can mitigate risk and reduce exposure to the volatility of any single asset. This approach provides stability and helps preserve wealth over the long term. So, while cryptocurrencies may offer the potential for significant returns, they also come with elevated risks that may not align with the investment objectives of the ultra wealthy. In conclusion, when individuals reach a certain level of wealth, their investment priorities shift from chasing high risk investments to protecting and preserving their assets. While cryptocurrencies may have their place in certain investment strategies, they are not necessarily suitable for everyone, especially those seeking to safeguard their wealth. In the end, whether you're investing in cryptocurrency, real estate, stocks, or gold, the key is to do your homework, diversify your portfolio, and invest with a long term mindset. After all, wealth isn't built overnight, it's built one smart investment at a time. Thanks for joining me today. Remember to like, share, and subscribe. Until next time, invest wisely.